this is an opportunity to come out better on the other side of this than in there. So while you do need barterability, I mean, frankly, that's the smallest part of my personal portfolio because it just needs to cover 10 years of my cost of living. And of course, I've included my children in that as well. But the lion's share of my portfolio is set up for growth and then also some legacy, but mostly growth. So, and the strategy is based upon repeatable patterns, but you also, understand too, the barterable part of your portfolio, you use that up, right? You're going to spend that to sustain your standard of living. Well, that means that you're spending your principal. And you need to have principal to work with to take advantage of the opportunities that come up, which are the kind of opportunities that will generate income after the reset is complete and we have a real viable currency to work with. And so you need to recoup those, and the strategy goes into all of that too. How do you recoup any taxes, any losses, any fees, anything that you use up? So it's a very comprehensive. I think it's a very comprehensive strategy.
It is, absolutely.
And it really looks at everything, but it starts with your goals. That's where it starts. It doesn't start at the end. The beginning is what you're trying to accomplish, and then you build the tools for the function that you're trying to accomplish. You have a fixed annuity paying out 6%, but treasuries, which are supposedly the safest thing, are paying out less than 2%. So that means that if you are getting paid more than this, what is considered the safest thing in the market, and I don't really think it is, that's where you hear my hesitancy, but that means that they're taking a lot more risk to generate that 6%. And those assets that they use to do so are not liquid. And you will see this for sure in the document. So, number one, what you have in an annuity is a contract. And any contract is only as good as the counterparty to that contract. So regardless of what your financial advisor says, you need to look on that contract. And what you will see quite clearly in lots of places is that this is based upon the claims paying ability of the issuer. So whoever you have the annuity from. So while they're going to guarantee the 6%, they can only guarantee the 6% as long as they can pay it. And according to the Fed's Financial Stability Review, and you'll see this if you watch tomorrow as well, the amount of garbage, for lack of a better word, that they invest your deposits in are not really liquid, and they're not enough to cover the claims that you may have coming out. And there are maturity mismatches, so they're going into things that aren't liquid, but when you want to get paid out on that annuity, that'll be at any moment. So if there is a rush and people go in and say, no, I want my payout now, even if it's on a monthly basis, the insurance company may well have a big challenge doing that. And so, yeah, your risks are great, especially if you are in a fixed rate product at an insurance company that has that money in illiquid investments, meaning that it's hard to liquidate when they need to. You are running a lot of risk. And anytime you're doing anything that is above what a treasury interest is paying, you are taking a lot more risk, and you're definitely not getting paid for it. So read your contract, and what you need to read on there is it's based upon the claims paying ability of the issuer. And according to the Federal Reserve, this is in jeopardy. When the crisis was unfolding back in 2007, 2008, I was paying really close attention to Lehman, and my attitude was, they'll never let it go down. No way, it's been around for 125 years, it's got such a good reputation, blah, blah, blah. and it overwhelmed the central banks. And, I'm really excited to do, I may not have everything done that I want to have done on the financial stability report because it just came out on Monday. And so I've been working furiously. Thank goodness Megan helped me to get it done. But that's kind of what they're talking about, and what we're seeing and what I'm going to show you. And I've shown you this before, but I'm going to show you again. I was so excited I did a happy dance because that TYVIX chart, right?
You found it?
I have, not new. They're not, they're not publishing it. But based upon the work from this financial stability report, and I always say, look, this is in 2013 is when they handed over control of the markets to the traders. And a lot of what they had in this report confirmed it. And I went, see, I've been showing them for, since 2016, and here it is. Here's the clear evidence. The correlation, it's there, period. It's just there. So I love it when what I know to be true is actually confirmed by the powers that be. You just have to be ready, right? I mean, I'm going to be shocked. I was shocked when they let Lehman go. I was shocked, right? And I'm going to be shocked when it happens on Tuesday morning at 8:30 or whenever it is. But I like being prepared. That's why I had a little 2-bedroom condo, was getting ready really to retire. I could lock the door and go off on my merry way and do the traveling, whatever that I was going to do. But in 2008, when that happened, instead I got rid of the condo and I bought a house that I feel was large enough that if my children and their families had to come to me, and then I immediately started converting it into an urban farm. I'm not a gardener, I'm not a farmer, but I had to do it because I believe my research. And I am so grateful that I've been working on it since 2010. That's when I bought the property. The FDIC is not there to protect your wealth because you're losing purchasing power.
It's just to give you confidence in the bank.
It's just to give you confidence. Exactly. And you think about when the FDIC was created, and you also think about how different countries around the world talk about the savings insurance. What they call it is a scheme. And it is a scheme. That's not my word, that's their word. In 2008, 2009, the FDIC actually stated that if one more small bank had gone under, it would have been obvious to the world that the FDIC was insolvent. One more. So the FDIC is not about protecting your wealth, it's about helping you feel comfortable to hold your wealth inside of the banks in the system.
Yep.